Welcome back to the deep dive. Today we're doing something a bit different. We're skipping right past the prepared remarks from the Bellring Brands Q3 2025 earnings call.
Yeah, we're diving straight into the really interesting part, the Q&A session.
Exactly. We want to get to the heart of it. What were the analysts really asking about? What were their big concerns?
And, what did management reveal maybe between the lines about the strategy, the future, beyond just the headline numbers?
Right. So our mission today, unpack those analyst concerns about things like competition, the outlook for next year, fiscal 26, and those tricky margin pressures.
We're basically hunting for the clues about how they plan to navigate what's clearly a booming category, but one that's also getting, well, pretty crowded.
Okay, so let's kick off with maybe the biggest question hanging over that call. What about next year? What's the deal with fiscal year 26?
Yeah, that was definitely top of mind for the analysts. They pushed on it.
And the company's hitting above its long-term targets, right? So you'd think they'd be eager to talk about it. What was the official line on guidance?
Well, the CEO was pretty direct. Basically, no early guidance for FY26 just yet.
Okay. Why the hesitation?
It was interesting, actually. He explained that historically, giving that early look was easier because they were always fighting capacity constraints. Demand was there. They just couldn't make enough product.
Ah, right. So their output was the limiting factor, making projections simpler in a way.
Exactly. But now, they're not capacity constrained. They have the supply. So paradoxically, it means they have to follow their internal planning process much more religiously, as he put it. They need to really analyze the market dynamics now.
So having enough product actually makes forecasting harder because market factors matter more than production limits. Makes sense. What specific things are they waiting on before they commit to numbers?
Two main things came up. First, they've got these really big club channel promotions launching late in Q4. They need to see how those actually perform. That's a big variable for momentum heading into 26.
Okay, see how the big deals land. What's the second?
Tariffs. They're still figuring out the full impact of the increased tariffs on their costs for next year. That directly hits their cost of goods sold projection.
Got it. So near-term uncertainty is driving that caution. But they didn't sound like they were backing off their long-term ambitions, did they?
Oh, absolutely not. They were very strong on reaffirming the long-term algorithm. That commitment is still 10% to 12% top-line growth.
And the margin target.
Still aiming for that 18% to 20% adjusted EBITDA margin range. Management basically framed it as, look, we're getting back to a back-to-normal environment now that capacity isn't the bottleneck. They expect to hit that on-algo growth.
And they seem pretty confident about their place in the market overall, right? I talked about a tipping point.
Yeah, very confident. They really feel the category is hitting an inflection point with retailers, and that Premier Protein is leading that charge. They even mentioned being the official category captain in several major retailers now.
Category captain. That's a big deal, isn't it? What does that practically mean?
It's huge. It means the retailers trust Bellring's insights so much that they're letting them basically advise on how to manage the entire protein category in their stores.
Wow, so they're influencing shelf placement, promotions, maybe even which other brands get space.
Pretty much. It helps them shape the narrative, grow the whole category, which benefits everyone theoretically, but ensures Premier Protein gets, the prime real estate and focus. It really cements their leadership position.
Okay, but leading the charge also paints a target on your back. Let's talk competition. That word popped up constantly in the Q&A. Why the sudden spike, especially in club stores?
Right, and this is where the context gets really fascinating and, frankly, a bit weird. The big jump in competition in Q3 wasn't just rivals suddenly getting aggressive.
No, what was it then?
It was driven by a major club retailer temporarily expanding the floor space for ready-to-drink shakes and powders.
Temporarily? Why would they do that? Just give more space to protein.
Get this. They did it to fill empty floor space left by other categories that got hit hard by tariffs. Think imported furniture, maybe tools, other goods. Those spots opened up, and protein shakes were apparently an easy, quick way to fill the gap.
Wait, seriously? So more protein competition showed up because of tariffs on furniture?
Bizarre, right? But that's what management indicated. This temporary space boost, which they expect to last only until maybe the end of this calendar year, gave a bunch of competitors a chance to get product onto the floor right next to Bellring.
That is wild. So a short-term opportunity for rivals, basically created by trade policy side effects.
Yeah.
Do they expect that extra competition to just vanish when the space shrinks back?
They're definitely bracing for those competitors to try and hold on to whatever gains they made. But, management put a positive spin on it.
Ah, the competition is good line. I heard that. How do they justify that? Sounds like classic corporate speak.
Well, maybe a little, but their argument is that more competition validates the category's growth potential. It forces everyone, including them, to sharpen their marketing, expand shelf space overall, and really push on innovation.
Okay, so it raises the tide for all boats, in theory. Did they offer any hard evidence to back that up, beyond just saying it's good?
The main point was household penetration. They kept emphasizing that the category is still only at about 52% household penetration.
Only 52%. What's typical for established CPG categories?
Mature categories are often way higher, like 80%, sometimes even 90%. So their point is, look, we're still in the early innings here. There's massive headroom to grow by bringing new people into protein shakes, not just fighting over existing users.
Okay, that makes the competition is good argument a bit more credible if the pie is still growing that much. So how does Premier Protein specifically defend its top spot? What's their moat? They mentioned a trifecta.
Yeah, the trifecta they see is 1, approachable positioning, it's not intimidating. 2, great taste and lots of flavors. And 3, solid nutritionals.
But what's the key differentiator? What makes people stick with Premier?
Texture. They hammered this point home. It's that thicker, milkshake, decadent consistency. Their core users want something that feels substantial, almost like a treat or a small meal, because it actually fills them up.
Right, versus some of the thinner, more watery options out there.
Exactly. They specifically contrasted it with thinner formats, maybe like ultra-filtered milk products. Their loyalists crave that richness.
Interesting. So texture is king. What about the actual protein source? Did analysts ask if consumers care if it's milk protein concentrate versus something else?
They did, and the answer was pretty clear based on their research. Consumers generally don't differentiate based on the protein source, like MPC versus ultra-filtered milk.
Really? So all that focus on ingredient panels?
It doesn't seem to be the primary driver for the average buyer, according to Bellring. What matters more is the brand name they trust, the taste, that crucial texture we just talked about, and the macros, the protein grams, sugar content, calories.
Got it. Brand, taste, texture, macros. Okay, let's shift to innovation as a way to capture those non-core consumers. The indulgence line launched earlier this year. How's that doing?
Indulgence sounds like a definite hit so far. They reported strong performance, particularly in mass retail, where 3 of the 4 flavors are apparently in the top third of the whole category.
Nice. But is it just stealing sales from their regular shakes, or is it actually growing the pie?
That's the key question, right? And they said about 50% of indulgence sales are incremental, driven by category expansion. So it's bringing in new users or encouraging existing users to consume on new occasions. That's exactly what they wanted.
Okay, half incremental is pretty good. What about the newer launch, the almond milk line? The non-dairy option?
Still too early to tell on that one. It only launched in late June, and the initial push was mainly on e-commerce.
Any early signs from online?
They mentioned an Amazon promotion saw a good trial, which is promising, but the real test comes now as it starts rolling out more broadly into physical stores this fall. We need to see how it does on shelf.
Right. So with capacity back online and this ramped up competition, temporary or not, what's happening with promotions? Are we heading into a discount war?
Analysts were definitely probing on that, but management's message was basically, we're just returning to our normal historical promotional cadence now that we can.
So not an escalation, just back to business as usual before the supply constraints.
That's how they framed it. They reminded everyone of the typical pattern. Q1, the holiday quarter, is usually low on promotions. Q2, the New Year's resolution period, is the biggest push, and often when new competitors try to make noise.
In Q4?
Q4 around back to school and sports season is another big promotional period. So expect more promotions than during the capacity constrained years, but aligned with their historical rhythms.
Okay, let's pivot to the financials for a moment because there seemed to be a bit of a disconnect. Q3 consumption came in slightly better than they expected,
Right.
but they narrowed their full-year guidance range anyway. Why tighten the forecast if things were looking slightly better in Q3?
Yeah, that caused some confusion. It came down to a few moving parts, some puts and takes, as they called it.
Okay, break down the puts and takes.
So the put or the positive was that slightly higher Q3 consumption, plus they got about a $10 million benefit from that temporary extra club pallet placement we talked about.
Okay, minor gains. What were the takes or offsets?
The main take was the assumption that increased competitive pressure, especially in those club channels where rivals got temporary space, would likely reverse some of those gains later in the year.
All right, but you mentioned timing issues too, something about inventory.
Yes, and this was maybe the more technical driver. Shipment growth didn't keep pace with consumption growth as much as expected in Q3. They thought there'd be more trade inventory destocking a deload.
But that didn't happen as much. Why not?
Because it was masked by a surprisingly heavy e-commerce load-in for both Premier Protein and their Dymatize powder brand. So online retailers stocked up more than expected.
Ah, so the inventory shifted channels rather than drawing down overall.
Exactly. They see it purely as timing. That e-commerce inventory is expected to fully destock or deload in Q4, so you'll likely see shipments lag consumption more significantly in the fourth quarter as that corrects.
Okay, that clarifies the guidance narrowly. Now let's hit the really painful point. Margins. They're forecasting a pretty steep gross margin decline in Q4, right? Like 300 basis points year over year.
Yeah, a full 3 percentage points down. That's significant pressure. They expect some offset from lower SG&A costs, but the gross margin itself is taking a hit.
What's driving that big drop?
Three main culprits. First, the higher promotional spending we already discussed, especially in club stores, as they get back to their normal promotional levels. That costs money.
Okay, more discounts. What else?
Second, input cost inflation is biting. Protein costs are going up, and they specifically called out elevated whey protein costs. That's really key for their Dymatize powder business, and they warned that whey pressure is likely to stick around as a headwind well into fiscal 2026.
Ouch. Rising costs hitting a core ingredient. That's tough. What was the third factor?
One-time costs. They estimated about 100 basis points or 1 full percentage point of the decline is due to non-recurring stuff. Things like costs associated with the packaging redesign and also just lapping some cost favorability they happen to have in the prior year that wasn't repeating.
Gotcha. And wrapping up the cost picture, those tariffs we mentioned earlier, the new 15% ones on dairy protein from places like New Zealand and the EU, what's the final verdict on their impact for FY26?
They quantified it as expecting a low single-digit impact on their total cost of goods sold for fiscal 26.
No single digits, so maybe 1% to 3% cost increase overall from tariffs.
That seems like the right ballpark. They're working on ways to mitigate it, sourcing strategies and whatnot, but they acknowledge they probably won't be able to offset it completely. So definitely a cost headwind baked into next year's plan already.
Okay, so let's try to synthesize this deep dive into the Q&A. Bellring sounds like a company that's confidently stepping on the gas, right? Leveraging its new capacity, expanding distribution everywhere like single-serve bottles and coolers, maybe even pursuing direct store delivery.
Definitely playing offense. They seem very anchored to that term 10-12% growth plan, really leaning into their category leadership.
But at the same time, they're clearly signaling, hey, watch out for the bumps.
Yeah.
There are near-term cost pressures from inflation, especially whey plus the new tariffs, and they're dealing with this, well, unique competitive flare-up thanks to temporary retail space shifts.
Exactly. It's a balancing act. They're managing growth ambitions against real-world cost and competitive pressures heading into fiscal 26. And what really struck me from the Q&A is how much the focus is shifting beyond just satisfying that core loyal consumer who wants the thick shake.
Right, the innovation piece seemed critical.
Totally. They're clearly building a segmentation strategy, using things like the indulgence line, the almond milk line, to deliberately target new users, new occasions, and expand the tent. It's not just about the original Premier Protein anymore.
Which brings us to a final thought for you, our listener, to chew on. If Bellring's big goal is to push household penetration from the low 50s closer to that 80% or 90% mark of mature categories, and they're already moving beyond the core thick shake with indulgence and almond, what's the next big disruptive move? What kind of new format or maybe different positioning could unlock that next big wave of consumers, the ones who aren't currently in the category at all?
That's a great question. What breaks the mold completely to bring in that final chunk of the market? Something maybe less decadent or more functional in a different way?
Exactly. What's the innovation beyond what we've seen so far? Something to watch as they eventually give that FY26 guidance.
For sure. The street will be looking for those signals.
Indeed. Well, thanks for diving deep into the Bellring Q&A with us today.
Always interesting to get past the headlines.
Definitely. Until next time, keep exploring the data.